Welcome to The Explainer. Today, we're diving into a really key tax-saving tool for India's plantation sector, and that is Section 48 of the new Income Tax Act. We're going to break down exactly how it works and, more importantly, how you can use it effectively.
So, if you're involved in the tea, coffee, or rubber industry, maybe you're advising a business or you're running one yourself, this one's for you. Have you ever wondered how you can strategically fund your estate's development and get a significant tax break at the very same time?
Well, that's where Section 48 comes into play. You can think of it as a powerful incentive, really designed to encourage businesses like yours to reinvest your profits right back into your own growth. Let's see how it's done.
Now, for all the seasoned professionals out there, this whole concept might be sounding a little familiar. And you'd be absolutely right, Section 48 isn't brand new out of thin air. It's actually carrying forward the principles of the old Section 33AB from the 1961 Act. So it's all about ensuring a smooth transition and continuity for the industry. Okay, so here's our game plan for today. We'll start with the basics, the what and who of Section 48. Then we'll get into the numbers, who's eligible, and how much you can deduct. After that, we'll walk through a real-world example, cover the all-important compliance steps, and finally, look at what happens if the rules aren't followed. All right, first up, the introduction. Let's really get to grips with the fundamental purpose of this provision and exactly who it's built for. So what's the big idea behind this section? It's actually pretty straightforward but vital. The government wants to boost development in the plantation sector. And the way they do it is by offering a tax deduction for funds that you specifically set aside in a dedicated account for, you guessed it, the growth and development of the business. It's a classic, effective incentive. Okay, now we get to the million-dollar questions, right? Who can actually claim this deduction? And the part everyone wants to know, how much is on the table? Now, this is super important. The eligibility is incredibly specific. This isn't just for anyone growing tea or anyone manufacturing it. The deduction is exclusively for businesses that are involved in both growing and manufacturing tea, coffee, or rubber, and it has to be in India. That dual condition, growing and manufacturing, is the first critical hurdle you have to clear. Okay, let's talk numbers. The way you calculate this deduction is a critical detail. The amount you can claim is always the lower of two figures. The first is the actual amount of cash you deposit into the special account. The second is 40% of your business profits, and a common trip up here is the profit calculation. Remember, it's your profit computed under PGBP rules before you take this specific deduction. Whichever of those two numbers is smaller, that's your deduction. All right, so you've figured out you're eligible and you know how to calculate the potential deduction. What's next? Well, now we have to get into the nitty-gritty procedural rules, the how, when, and where of handling these funds.
First things first, the timeline here is no joke. It's super strict. You have to make the deposit within 6 months from the end of the tax year or before you file your income tax return, whichever date comes first. Honestly, timing this deposit is key to managing your cash flow. And you have two choices for where the money goes: a special account with NABARD or a deposit account with the relevant board, whether that's the tea, coffee, or rubber board. So you can't just take the money and use it for a vacation, right? There are rules. The money you withdraw has to be used strictly for purposes that are laid out in the specific schemes approved by the respective commodity boards. This is the control mechanism that makes sure the tax benefit is directly fueling genuine development. And of course, there's a flip side. There are very clear things you cannot do. If you misuse the funds, say you buy some fancy office furniture or machinery for a guest house, that amount immediately gets reclassified as deemed income, and guess what? It becomes taxable in that same year. Sticking to the approved scheme is absolutely non-negotiable.
Okay, enough with the theory, right? Let's walk through a practical example so you can see exactly how this plays out in the real world. It makes a lot more sense when you see the numbers. So let's introduce our case study, Sunshine Tea Co. They tick all the boxes for eligibility. They both grow and manufacture tea, and they do it in India. Perfect. Now for the tax year we're looking at, their profits from the tea business, calculated before claiming our deduction, stand at a nice round 50 lakh rupees. And being smart about it, they've gone ahead and deposited 18 lakh rupees into their special NABARD account well before the deadline. Okay, let's do the math here. It's that lower of the two rule we talked about. First, we have the actual amount they deposited, which is 18 lakhs. Second, we calculate 40% of their profits. That's 40% of 50 lakhs, which comes out to 20 lakhs. So which one is lower? 18 lakhs, of course. That means Sunshine Tea Co. can claim a deduction of 18 lakh rupees. Simple as that.
So the calculation is done, the benefit looks good, but hold on, you can't just claim it without the right paperwork. This brings us to a critical compliance step, the audit report.
This is non-negotiable, folks. To claim this deduction, you absolutely must furnish an audit report in Form 182. As per Rule 290 of the income tax rules, a chartered accountant has to certify your claim. And pay close attention to the deadline. It's due 1 month before your ITR filing due date. You really have to plan for this one in advance.
So what's the auditor actually looking for in this form? Well, think of Part 3 as their compliance checklist. They'll need to verify that you're keeping separate accounts, check all the details of your deposits and withdrawals, and confirm that any assets you bought with these funds are sticking to that lock-in period. Which, of course, brings us to the big question. What happens if you don't follow these rules? What happens if you mess up? Let's talk about the consequences.
One of the biggest tripwires here is the 8-year lock-in period for any assets you buy with the withdrawn funds. If you sell or transfer one of those assets before 8 years are up, the entire original cost of that asset is clawed back. It gets taxed as deemed income in the year you made the transfer. And trust me, that is a severe penalty you want to avoid. All right, we have covered a lot of ground, so let's boil it all down to a simple checklist of the most crucial points you need to remember about Section 48.
So let's recap the essentials. First, eligibility is strict. Tea, coffee, and rubber businesses doing both growing and manufacturing. Second, your deduction is always the lower of what you deposit or 40% of profits. Third, watch those deadlines for your deposit. Fourth, Form 182 is mandatory, not optional. And finally, respect that 8-year lock-in on assets. If you can master these 5 points, you're well on your way to using this provision successfully.
And that's a wrap on our deep dive into Section 48. Thank you so much for watching. If you found this useful, please do us a favor and like, subscribe, and share it with your colleagues who might also benefit. Just a quick note, this video is for educational purposes only and it's not professional advice. Tax laws are always subject to change, so please always consult with a professional advisor before you take any action. This is an AI-generated educational video.